Warren Buffett is probably the greatest stock picker there's ever been. So it's always interesting to look at his letter to shareholders to see the thinking behind his portfolio. Now, what's piqued people's interest at the moment is the huge amount of cash which he's holding. Now, that actually stems from the way his business is constructed and also the fact that he's a value investor. So in this video, we're going to dig deeper into what it means to be a value investor, but also the structure of his business, because that explains, I think, why he's holding so much cash. If you want to discuss the investment strategy on your own portfolio, that's precisely the kind of thing which we talk about on our Sunday evening calls. It's very easy to sign up, it's just $5 a month. But now let's look at why Warren Buffett's holding so much cash in a bit more detail. This is not a recommendation. If you want advice tailored to your specific circumstances, seek independent financial advice. At the latest shareholder meeting in Omaha, Warren Buffett and Charlie Munger, who run Berkshire Hathaway, talked about the size of their cash cushion because investors are interested in why they haven't spent the money. And part of their reply was that there are times when it's raining gold and all you have to do is go outside. But Buffett said he didn't know when that was going to happen. But the implication is that at the moment it's not raining gold. And in terms of Berkshire's annual returns compared to the S&P, it certainly isn't raining gold. This is the relative performance of Berkshire Hathaway versus the S&P 500 going back to the inception of the fund. And while there were years when it was spectacular in terms of its outperformance, that certainly hasn't happened for a while. And as the size of Berkshire Hathaway has increased, you can see that the effect has been to reduce those outsized returns. And 2019 was particularly unimpressive, with an underperformance of 21%. But one thing to bear in mind is that Warren Buffett's investment style is to look for value. And if we look at valuations of the S&P 500 going back over a century, the periods in red are when we're above the median valuation. Because in the past, investors have paid about $15 for every dollar of profit generated by the S&P 500. But recently, they've been willing to pay much, much more. The periods when you can find greatest value in the stock market is when everyone capitulates. In other words, nobody wants to buy stocks. And after this period of very strong equity returns, we're very far from that situation. So in order to better understand why Buffett isn't spending his cash, it pays to understand his value style of investment. A value investor will always have the true value of a company in mind. If the market price is above that true value, then it's expensive and they wouldn't buy. Whereas if the market price is below the true value, then it represents a bargain and they probably would buy. Warren Buffett always talks about Benjamin Graham's idea, which is the concept of Mr. Market. Mr. Market is an imaginary business partner who's willing to trade with you on a daily basis. But he has an unfortunate problem, which is that he always overreacts to news. At times, Mr. Market feels euphoric and can only see favorable factors affecting business. And in that mood, he'll set a very high price for assets. And this represents an opportunity for you to sell your assets to Mr. Market at overvalued prices. But when Mr. Market's depressed, he can only see the downside. And this represents your opportunity to buy assets at depressed prices. But as he said in his letter to shareholders in 1987, Mr. Market is there to serve you, not to guide you. If you can't value businesses better than Mr. Market, in other words, the equity market, then you don't belong in the investment game. So for a value investor, the key skill is to calculate the true value of a company. And in order to do that, you have to have an educated guess at what future cash flows that company will generate. The cash flows will stop when you either sell your investment, the company goes bankrupt, or it gets taken over. And because dividends are paid back to you out of the profits of a company, or in other words, its earnings, you should look for companies where that earnings growth is as large as possible, but also sustainable over the long term. And that's the key skill at which Warren Buffett has excelled in the past. But how do you turn those cash flows in the future into a value today? The key concept here is the idea of a discounted cash flow. The further in future in which a dollar is paid to you, the less that dollar is worth today. And if we apply that concept to those cash flows at the top, you can see that they steadily decrease in size. So the final step in our valuation process is to add up the sum of these future discounted cash flows to give us a value today. Another unknown is what interest rate you should apply to discount the cash flows. People usually use government bond yields because those are considered to be risk-free rates. At the moment, interest rates are very low, and that means that we're not so heavily discounting future cash flows, which means that the present value of companies has increased, and low interest rates are one of the reasons why equity prices are so high at the moment. Now let's look at the size of Warren Buffett's cash buffer. In his 2019 letter to shareholders, Buffett said that the size of the cash pile was $112 billion with another $20 billion in bonds, and that he considered a portion of that stash to be untouchable, such that he'd always hold at least $20 billion in cash to guard against external calamities, and also that he'd avoid any activities that could threaten maintaining that buffer. In a Yahoo Finance interview with Andy Serwer, he explained why it was his duty to shareholders to maintain that buffer. And the reason why was insurance claims. So for example, there could be hurricanes or other natural disasters, which would mean that Berkshire Hathaway would have to pay out billions of dollars. And he said his investors expect him to run the place so that he could get through periods like that. And the reason those payouts could happen is because of Berkshire Hathaway's core business. Warren Buffett describes the insurance business, and more specifically the property casualty insurance business, to be the engine propelling Berkshire's growth. He bought his insurance company for just $8.6 million in 1967, and now, in terms of net worth, it's the largest property casualty business in the world. And the reason why he likes this business is that you get premiums from your customers up front, but you only pay the claims to those customers later. And because of that collect now pay later business model, property casualty insurance companies end up holding large sums of cash, which are called float. And the company gets to invest that float for their own benefit. And this graph shows the increase in the size of the float for Berkshire Hathaway. By the end of 2019, it was $129 billion. Now, most insurance companies will have to invest their float in very safe assets, because if they invest in the stock market just before a crash, they may not be able to make good on their customers' claims. In the past, that wasn't such a problem because you could get interest rates of over 10% for investment-grade credit. But because interest rates have been falling steadily over the last few decades, float can no longer be profitably invested in the investment-grade credit market. And Buffett refers to bond markets currently offering pathetically low rates. But Berkshire Hathaway is fundamentally different because it has a huge and diverse stream of non-insurance earnings, which means that he can invest his capital into many of his own businesses, which he owns outright. So why hasn't Buffett spent his money? It's not because he doesn't intend to. In 2019, he made it very clear that he did want to move his excess liquidity, that's his cash, into businesses that Berkshire would permanently own. But the reason he gave for not doing that was that prices are sky high for the kind of businesses he likes, which have decent long-term prospects. This is the portfolio of companies which Berkshire currently owns, as of 2020. And the prospect of an elephant-sized acquisition, as he calls it, certainly gets his pulse racing, which is no mean feat given that he's 88 and his partner Charlie Munger is 95. But presumably businesses have failed to meet his 3 criteria for acquisitions. Those are good returns on net tangible capital, able and honest managers running the business, and of course a sensible price, because he is a value investor after all. In 2020, he used a marital metaphor for business acquisitions. They start with a joyful wedding, but then reality diverges from prenuptial expectations, sometimes wonderfully, delivering bliss beyond either party's hopes. However, in other cases, disillusionment is swift. A recent example of that swift disillusionment would be Berkshire Hathaway's investment in Kraft Heinz. The stock price of Kraft Heinz fell fairly rapidly in 2019, partly because its revenues failed to meet expectations. And Buffett was quite open in saying that he'd made a mistake. He'd simply paid too much for the company. But certainly in the past he's made some very good investments, 2 of which are a railroad company called BNSF and Berkshire Hathaway Energy. And these earned a combined $8.3 billion in 2019. Railroads in the US offer a very fuel-efficient way of moving goods from A to B across what is a very large country, and they produce less emissions and cost less than simply transporting things in trucks on a highway. BNSF is a very large company with over 40,000 employees, and it transports a combination of agricultural products, consumer products, and industrial products. This map shows its network across the United States and also reaching up into Canada. And it's a very capital-intensive business. You're constantly having to update the rolling stock and also the track. So it's perfectly suited to Warren Buffett's portfolio approach to companies because he can siphon money from capital-generating businesses to capital-intensive businesses such as BNSF very easily. Berkshire Hathaway Energy is also a capital-intensive business because here you have to build infrastructure for generating energy. And I strongly recommend you take a look at this video, which shows the construction of Berkshire Hathaway Energy's Topaz solar farms. The sheer scale of this solar installation is utterly breathtaking, and to an old physicist like me, quite exciting. Now, if you can't buy whole businesses, what Warren Buffett does is buy shares of existing companies, but he sees this as a bit of a cop-out. But here also he's applying his value criteria, and he points out that the companies which he owns shares in are currently generating a hefty 20% return on net tangible equity, and they do that without employing excessive levels of debt, which can turn out to be problematic in the event of a credit crisis. That 20% makes the 2.5% or even less on 30-year US Treasuries pale in comparison. And Buffett's certainly a conviction investor, which means that he owns a large slice of the companies in which he invests. So for example, he owns about a fifth of American Express, and almost 6% of Apple, 10% of Coca-Cola, and 13% of the ratings agency Moody's, for example. And his combined equity holdings in 2019 were worth a total of $248 billion. And it's no surprise that they love to consume Coca-Cola, in which they have a large shareholding. At the annual general meeting, you can see both Warren Buffett and Charlie Munger doing a bit of product placement. And Coca-Cola certainly satisfies the criterion of generating a large return on the capital employed. In 2019, its net operating profit was just under $9 billion, on about $50 billion of capital employed, which gave a very high return on capital of over 17%. The return on capital employed for Coca-Cola was extremely high up to about 2011, when it seemed to fall off a cliff, but it does seem to be improving. But one thing that almost any investor will love is the fact that dividends from Coca-Cola have been steadily increasing for decades. Now, as a stock investor, Warren Buffett is quite stoic when it comes to drops in the equity market. You can almost imagine him shrugging his shoulders when he says occasionally there are going to be drops in the market of 50% magnitude or even greater. But due to the ability of American companies to increase their earnings over time, which he refers to as the American tailwind, and the fact that reinvested profits compound over time, mean that equities, in his view, are the much better long-term choice for the individual who doesn't use borrowed money and who can control his or her emotions. In other words, they don't sell when markets fall. One thing that's confused some investors is why Warren Buffett's not buying back Berkshire's own shares, because that increases the share price of the company. As with any other investment, Buffett applies the value approach. He'll only buy back his own stock if both he and Charlie Munger believe it's selling for less than it's currently worth, because otherwise you'd be instantly destroying the value of the stock by overpaying for it. He's also very keen to keep that ample cash reserve just in case of calamity. But he does admit that when calculating the intrinsic value of a company, there's a bit of leeway, 10% up or down. So in 2019, they actually did buy back $5 billion of Berkshire's own shares, which is about 1% of the market cap of the company. But they're going to be more aggressive about that if the price to value discount gets larger. What they'll never do is simply prop up the stock because the share price has fallen. The letter to shareholders in 2020 also talked about the road ahead. Buffett jokes about a friend of his who was asked for biographical data by a newspaper to use in his own obituary. He obviously didn't reply quickly enough because a month later he got a second letter from the paper labelled urgent. And he admits that he and Charlie long ago entered the urgent zone. But he gives 5 reasons why Berkshire shareholders need not worry. Firstly, Berkshire only buys companies which give good return on capital. Secondly, having all of these companies under one umbrella gives Berkshire some important and enduring economic advantages, being able to shuffle capital from companies that generate it to those that require it. Berkshire is also very cautiously managed so that it can withstand external shocks, and that's one of the reasons behind having a very large capital buffer. Berkshire is also very careful about choosing good top managers, and he says the directors are very concerned about the welfare of owners, but also on preserving the culture of Berkshire Hathaway, which he says is rare among giant corporations. So hopefully that explains why he's holding so much cash. It's partly the nature of the insurance business that you have to have money there available in case there are big claims, but also he's holding money back in case there's a big deal that comes along, which is very well priced. So I hope that's been useful. If you do want to join us on Patreon, it's very easy. It just costs $5 a month and you get access to Slack, all of our previous Sunday evening calls and any new ones. And as always, thank you for listening.